Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a chilly Redmond, Washington. Happy Wednesday. Happy NVIDIA earnings day. We got a lot of charts to break down. That growth trade that has been dominating for so long. Names like SMCI, NVIDIA, and others really starting to pop lower through the course of this week. Today, nice rally into the close. Could be some short covering leading into that NVIDIA earnings announcement here right after the close. We're recording this right after the market is closing here in the U.S., so we'll keep our eye out on NVIDIA trading after hours, see what sort of initial reactions we can tease out from the charts. But overall, I would say the broader story we're going to be talking about here today is the growth leadership taking a pause for now. We'll see if NVIDIA can re-engage those stocks to the upside after a bit of a pullback. And starting to see an emerging trend of leadership from some of the value-oriented sectors. Top two sectors today were energy and utilities. So some of the sectors that have been doing the worst on a relative basis actually starting to improve quite a bit. When I'm scanning for stocks making new highs, I'm finding a lot of energy names. I'm finding plenty of industrial names, insurance companies, a bunch of things that are outside of technology and consumer and communication services. Now, of course, NVIDIA's earnings can be quite a catalyst, and I would say a lot of focus particularly on this one company and what it implies for the growth trade, what it implies for the trajectory of these AI companies and the AI-fueled rally. With that in mind, let's check in on all the charts here on our market recap and see what we learned today about the markets. Before we get there, we're going to talk about interest rates in a little bit, because I would say that's part of this story about the growth trade as well. Where will the 10-year yield, $TNX on our platform, where will it be 1 month from today? Over 5%, between 4.5 and 5, between 4 and 4.5, or below 4%. We're kind of all in that 4 to 5% range. Let's take a look at the chart of the 10-year Treasury yield, and you'll see what I mean. We're sort of right in that range right now. So I'm not surprised that that's where most of the responses kind of came in, and I probably would agree. I mean, I basically gave you this range from 4 to 4.5%. From 4.5 to 5%, above 5%, below 4%, which is actually not too far below current levels. 1 month from today isn't a lot of runway. So the chances of us getting all the way to 5%, retesting the October high and eclipsing that, I would say very, very low, right? In terms of probabilities, it's a possibility, but I would say highly unlikely. That's kind of like the S&P going down and retesting its October low and then going through it. That's certainly a possible scenario. I would say highly unlikely given how far that is and how quickly that would have to change, but it's possible. Bonds would have to sell off aggressively to get up to that point. Now, getting above 4.5% is not too far above current levels. That's a 1.5 above where we're at right now, a little more than that. And if we would have sort of rates higher for longer, if we continue to see economic data that suggests that inflation is still not down to that bogey that Palo and others at the Fed have been talking about, rates going up to that point certainly makes sense. And what you have to remember is if the 10-year yield goes above 4.5, 4.6, 4.7%, we get up toward the general direction of the October peak in rates. What does that do for growth stocks? Certainly is not a good environment for growth. That's actually quite the opposite. That is tends to be where growth stocks have a much tougher time of things. They can still work, but not so much. Again, the chances of us going below 4%, I would say much more likely than above 5%, just because of how close it is and how choppy we could have some volatility in the bond markets. I would probably say between 4 and 4.5%. Actually, that's not true. I'll say 4.5 to 5. I'll be along with the group. I think that's a fair assessment. I think rates we're going to remain higher for longer. I think expecting a bond rally here is probably premature. It could happen. But for now, I'm thinking rates probably push a little bit higher from here, and I wouldn't be surprised if some growth stocks still do quite well with that as the backdrop. But the point of this exercise is really think about these different probabilities, to think about what could happen and what that might mean for your portfolio of growth stocks or energy names or utilities or whatever it is that you're choosing to hold at this particular time. Keeping going here with our market recap, it was a crazy end to this session. I think the market has been fascinating to observe and to analyze these days. And I would say today, up until about 3:30 p.m., this looked like a pretty rough day for stocks overall. The S&P rallied aggressively into the close, and that's the last 30 minutes of trading, which my general sense is you had a lot of things sell off here in the last couple of days. I would say a lot of people are super not excited about having exposure to certain names, given NVIDIA's release and what might happen. I would say if you were short the market here, probably not super comfortable shorting it through this earnings report. You get a lot of short covering would be my guess as to what generally was going on here. And that combines with people kind of buying on the dips and assuming that we have a great report from NVIDIA and that juices the markets to this next leg higher. Boy, Thursday's show is going to be very exciting. I'm excited to be a part of that one because it could be a tale of two very different markets depending on how things go. Anyways, the S&P finishing just narrowly in the green. That's around 49.82, we'll call it. The Dow Jones Industrial Average just announcing a new member and a switch in the 30 members of the Dow, which we'll talk about here in a moment, finishing the day just above 38,600. That's not too much above current levels. And again, a nice rally into the close there. The Nasdaq rallied as well, but still finished about 1/3% lower than Tuesday's session. Mid caps and small caps mixed, with the S&P small cap index down just over 1/4%. That's the worst performer of the three cap tiers. And the VIX actually pushing lower, not too much, right? 0.1 VIX points. So we were around 1540 yesterday. We're down around 1530. We're still sort of in that 15 range. And again, what we talked about with the VIX is the levels of the VIX. I would argue when you've had a low volatility environment, the levels of the VIX can be helpful at helping you differentiate. Is this just a brief pullback? Is this a more meaningful pullback? Is this a significant corrective phase? And I think the level of the VIX can help sort of illustrate that, right? Because if the VIX never gets above 20, this probably just isn't that bad of a move because sell-offs happen with accelerated volatility, with increasing volatility. So keep an eye on the VIX for sure and look for spikes in volatility. That can often be a big red flag for stocks. Now, bonds tend to basically sell off through the course of the day today. You can see the $ TYX, which is the 30-year yield, $ TNX, which is the 10-year yield, sort of moving steadily higher over the last session and a half. The 10-year yield was about 0.5 point higher, around 432, well, 433, we'll call it. The long bond yield just below 4.5%. The 5-year yield around 4.3%. The short end of the curve, of course, is still very high. So we still have that inverted yield curve that has been in the definition of the conditions for quite some time here. With the lower end very, very high, with the longer term yields much lower than that. Bond prices moved down through the course of the day today. The TLT was down almost 0.75%. And the dollar index, not too much of a change from yesterday's close. Looking at the commodity space, the DBC was up 0.4%. Crude oil prices actually did quite well. The natural gas ETF, check this out, was up 12.5% today. Now, natural gas prices have been coming down quite a bit here recently, actually having a nice counter trend bounce to the upside today. Copper prices and oil prices all up as well. You can see silver, one of the few that were actually in the red today, down about 0.5%. Gold prices essentially unchanged from yesterday. Mostly red on the chart of cryptocurrencies are on the table here. We have Bitcoin down just over 2%, Ether prices down over 3%. And this is after Bitcoin has eclipsed that big round number resistance at 50,000. It's currently sitting just above 51,100. Ether prices have stalled out in their attempts to get above 3,000 and stay there. We're actually back below just above 2910 as we're recording the show. Looking at the 11 S&P sectors, you can see energy number 1 up almost 2% today. Utilities number 2 up 1.3%, followed by consumer discretionary, the XLY, and real estate basically tied for a third, up about 0.75%. You know, if you look at energy, up almost 2% today. When I'm scanning for stocks making new 3-month highs earlier today for my market misbehavior premium members, found a lot of energy, and it was across different groups. Things like exploration and production names, gapping higher. Something like Diamondback, Fang is a good example of that. Integrated companies like Exxon, Chevron, and it was others sort of further down the cap tiers within the integrated oils that were having pretty decent breakouts. But a lot of energy stocks on the new 3-month highs list today. On the bottom of the list, I didn't get there. The Fang sectors, I guess. Technology down about 0.2%. Communication services just slightly below zero. Healthcare third from the bottom. Financials as well. Down about 0.2 to 0.3%. Our market trend model remains bullish in all 3 timeframes. It hasn't been enough of a drawdown yet to trigger my short-term model turning negative, but it's sort of right on danger watch, I would say. I'm sort of looking to see if we finish Friday's close below there. Arguably, what happens with NVIDIA today into tomorrow probably going to be a big part of that thesis for sure. We're going to do a segment called Banking on Breadth later in today's episode, so I'm going to skip some of the breadth indicators in our market recap because we'll have time to dig in a little deeper to some of the themes that we're observing there, but I think you'll probably be able to tell by what I'm showing you on some of the charts that the conditions overall have gotten less optimal. Now, what's interesting is today looked very different by the close. This is one of those times when, with candle charts, you really want to wait until the close to make any conclusions, to draw any conclusions about a particular candle pattern. Up until about 30 minutes before the close, today's bar actually looked quite different. We're at the lows of the day. We were below 49.50, and it felt like we were going to have another down close, third day in a row of closing lower. We actually finished just slightly in the green, and that's because of that late stage rally going into the close. Now, we're still below this trend line support, and I would think that's still arguably a pretty important line to follow. So for now, that initial assessment of trend change has been triggered. For me, the confirmation, right, what confirms that we're really in a pullback phase, I think it's the 48.50 level. That would be the swing low from late January, and also the 50-day moving average, still around 48.30, 48.50. So if we do sell off later through this week after NVIDIA's earnings, that's where I would be looking for potential support around the 50-day moving average. And if we get good news today from NVIDIA, and if markets open higher tomorrow, 50.50, that's the high water mark for now. That's your high from about a week and a half ago. See if we can push above there. Maybe set the stage to advance onto 5,100. Now, I did a webcast yesterday on RSI, which I mentioned on the show a couple times. The momentum overall for the S&P has been quite strong. And what you have to remember is the RSI has not been below 50 since right after the October low. Right after that initial rally, the momentum has been quite strong. The RSI hasn't even gotten below 50 this entire time. So, looking for changes of character, when the RSI has a particular phase or particular trend, look for something different. So I think an RSI breaking below 50 as we would start to test those levels would tell me the momentum is starting to shift. As of today's close, it's telling you that we're holding up actually quite well. And again, we're not making a new swing low just yet. So as much as the markets could feel a little uncomfortable, we're not really getting any sort of breakdown yet. Looking at, now I will say, we'll look at some individual stocks that have actually gapped down quite aggressively today. SMCI, NVIDIA, and others through the course of this week. Palo Alto, Zscaler, I got a bunch of tickers to go through if we can. As a concerning sign outside of breadth, I would say the increase that we're starting to observe in sentiment definitely has me, has my awareness. I'm watching the chart of the VIX very closely every day. And the reason is because this green shaded area has been these quiet, sort of slow and steady advances that we saw in the summer of last year, at the end of last year in December, and then continuing on to January, really into mid-February, right? We're sort of making higher highs and higher lows. Volatility is remaining very low. This is sort of a nice, classic, long and strong, up and to the right uptrend that's starting to change a little bit, right? You're starting to see the VIX put in daily readings above 15, which is sort of that initial level for me of, is the uptrend maybe pausing? And that's, I think, where we're at right now. Breaking above 20 is things are getting a lot worse, and you really need to think about downside protection. And above 28.50 would be, this is really a challenging, probably more of a protracted, longer-term decline, more of a cyclical decline as opposed to a tactical decline. So we've still only just triggered that first initial warning, but that's how really bad readings tend to start, is with that initial bad reading. So that's something to point out with volatility. Let's talk about some of the key names here. NVIDIA, we're going to talk about, of course, for earnings. Now, after the close, just slightly higher, about 1/3% higher. We're sort of right after the close here, so we'll see when the initial prints hit and what sort of reaction we would get. But certainly a potential for the stock to move aggressively. Think about the sentiment going into today's session, though, or into today's close. If I just look at the last year, you can see obviously the incredible run that NVIDIA has had, and what's so fascinating is we broke above 500 here, just a classic big base breakout. That's what I think of as a sort of a basing pattern, a sideways rectangular shape, and then you finally break out. And what that bar tells you is that something is different, right? People have not been interested in accumulating NVIDIA much above $500 a share until they start to be very interested in doing so. You're seeing additional buyers willing to pay more and more, willing to pay over, the previous 52-week high day in, day out, as more and more optimism is priced into the market. This got another 50% gain up to 750 almost over the last couple weeks. Now the last couple days has sold off. So that's Friday's close. We had the Monday holiday, Tuesday, Wednesday now coming off a little bit. Now, NVIDIA rallied into the close along with kind of everything else, but still down about 3% to the day. So overall, we've sold off pretty good going into this week's report. The RSI, I think, tells a great story here. NVIDIA became overbought the second week in January, spent this entire time in the overbought region. And then I think just on yesterday's close, finally came out of that overbought region. What I was taught is when a stock becomes overbought, that's actually quite good. That means that the price is going up a good deal, and that's actually quite encouraging if we own the stock. What you're looking for is that warning sign when the RSI comes out of that overbought region. That's what we've just observed this week. So I would say, this trend overall, the longer-term trend is still healthy because we're still making higher highs and higher lows. That would be the question coming out of an earnings report. And for me, it would be, do we hold 600, which would be that kind of swing low. It's so compressed here that it doesn't seem that important. But I would say that 600 level is probably important, and the 50-day moving average as well. That's kind of my general go-to. When you have a stock that's had a big run, you start to pull back, I immediately look to the left to find the recent swing lows. I look at the 50-day moving average. Those levels hold, and things just aren't getting that bad. Those levels fail for some reason, then we really want to get concerned. That's what I'll be looking at through the remainder of this week, particularly if we get some disappointing news today for NVIDIA. SMCI, super microcomputer, selling off this week as well. One of the charts I want to show you here is what we call a candle focus chart. Just a classic bearish engulfing pattern, right? This is where you have a big up day, then you have a big down day, which is even more important, where the body open to close engulfs the open to close body of day one. So day two, higher open, lower close. That just really speaks to distribution. So you saw a lot of that type of behavior so far, from the end of last week into mid this week. Names like Super Microcomputer have had such an incredible run, selling off aggressively, showing bearish candle patterns and pulling back a little bit. Just today, we have Palo Alto Networks gapping down quite a bit. Let me go to just the regular daily chart so we can see where that is. I mean, look at the gap here. Now, even up until yesterday, this is a really strong chart, and this is one of the risks you take on by owning a stock. By owning any individual name, you are accepting a bunch of risk, right? And that's sort of the general value proposition, for lack of a better term, of investing in an equity, right? You're expecting additional return beyond a risk-free rate, right? You could just buy a savings bond with your money, but instead you're buying an individual stock, which means you're expecting a greater return than nothing, or than like a regular savings account. But you're also accepting additional risk, and that's why you're worth, your stock could be worth much more, because you're taking, possibility for greater return, but acceptance of greater risk. One of those risks for individual stocks is earnings risk, right? Volatility risk. The fact that things can just change very suddenly, arguably, is one of the benefits of diversification in ETFs, is that you limit your exposure to a particular gap. But if you own Palo Alto Networks today, you're probably waking up to a lot of red. It closed down almost a third of the way lower, down to zero, down almost 30% today, gapping below the 50-day, and it wasn't even close. Gapping below the most recent swing low, and it wasn't even close. And gapping below that January low. So we made a new low for the year just today. So now I think it's about, do we hold the 200-day moving average? We went from overbought to oversold in just a couple trading sessions. So at this point, this is one of those cut your losses, reassess, see if this is a good new opportunity. And the fact that it sold off through the course of the day today, I think tomorrow is going to be really interesting to see if we're able to hold that 200-day moving average. Looking to the left, you see potential support here. Applying Fibonacci retracements is sort of another way to think about a name like this that is just gapped down so aggressively, right? So here, if you look, we didn't even touch the 38.2% retracement level. That's here, which lined up with the January low. We're now down about the 50% level. So here's what I would say. The way that I think of a chart like this, it's now broken, right? Undeniably so. We get back above this level, the 38.2% level, then maybe it's worth your attention. That's how I would think of it for now. Now, it means a lot to see if we hold the 200-day, to see if we drift lower, to see if additional buyers come in through the remainder of this week. Thrilled to get a great company like this at a deep discount from where it was earlier in the week. But that's a big open question at this point. I think the chart is now guilty until proven innocent. Now, I mentioned a change in the Dow, just so you know, just a full disclosure here. Walgreens Boots Alliance booted, pun intended, from the Dow Jones Industrial Average. The Dow doesn't change members very often, which is why I wanted to point it out to you. It's replaced by a name you may be familiar with, Amazon. So friendly reminder that when you think of an index like the Dow or the S&P or the NASDAQ, this is not a static group of stocks. that you're following over time. It's actually a very fluid group, and it's up to the company, Standard & Poor's or Dow Jones or whoever, to determine what those members are. So they decided that Amazon has a better place in the Dow 30 than WBA, Walgreens. Now, worth noting, if you look at when stocks are added to the Dow, it doesn't tend to be very good. Usually in the short term, there's a little bounce, but over time, it actually tends to deteriorate a little bit because of that. I would argue that's probably because they don't usually add things that are really beaten down. They add things that are working, like Amazon. So after they add them, often they take a bit of a break after that uptrend. We'll see how things materialize from there. But one of the Dow 30 changing hands today. That's it for our market recap. Again, a lot to think about with NVIDIA's earnings. We can't talk about it too much just because we're in the after-hours session, but certainly on tomorrow's show, we'll address some of the aftermath. And I would encourage you to think about some of these names that have had big gaps, to look to the left, think about where we're at relative to where we've been, start there, and then build your story, build your mosaic from that point. Couple quick announcements before we continue on the show with a segment called Banking on Breadth. First off, as we would welcome your questions, we're going to do a special all mailbag episode of the show on Friday, and we would love to feature one of your questions in our next mailbag episode. Email is always best, thefinalbar@stockcharts.com. You can get your questions to us right there. On X, just tag us in a comment @FinalBarSCTV, and on the YouTubes, just drop a comment below the video that you're watching. Thanks so much for liking our videos, for subscribing, for telling your friends about it. We super appreciate it, and we very much appreciate your questions as well. Also, we are looking to reestablish the future of Stockcharts TV. Think about what the Final Bar could look like. What do you like? What do you not like? What do you want us to do more of? What do you want us to do less of? Here is a rare opportunity to get your feedback directly to us. We will all be looking at these survey results and then making some decisions afterwards. So scan the QR code that you see on your screen. Click on the link in the description below the YouTube video. Please take a few moments and answer some questions on our survey. We'd really appreciate some feedback from all of you as we think about what sort of stories and what sort of programs we want to tell here on Stockcharts TV. All right, let's continue on with our next segment called Banking on Breadth. If you watched this show for a while or followed my work, breadth is a big part of how I think of things. And I think of market sort of macro analysis in three general phases when we're thinking about equities. At the top, it's an analysis of price or trend, right? What are the major averages doing? What's the S&P doing? What's the NASDAQ doing? It has to start there. Below that is market breadth, because the S&P is very geared towards a bunch of, or actually a small number of big growth names. So what about all the other stocks that are in the S&P? What about all the other stocks that are on the New York Stock Exchange? That's what breadth conditions, breadth analysis helps us understand, the behavior of all the other companies that are part of those indexes. And then below that, you have sentiment, like volatility, like options data through the put-call ratios, survey data. That's all, sort of tertiary down the list beyond price and breadth. So with that in mind, I'm going to use the Mindful Investor Live chart list, but I do have, as part of the chart pack that I have on stockcharts.com, I have a full breadth chart list, and I'll include a link to that chart pack, which you're welcome to access. All Stockcharts members are able to access that for free. So let's look at some of the measures of breadth. I always like to start with what I call breadth by cap tiers. This is a very simple way of looking at breadth data, right? So if you look at the daily advanced decline data, if I was a short-term trader, if I was a day trader, I'd pay a lot of attention to the daily advanced decline readings. I think that tells you a lot about what the markets are doing, what companies are doing day in, day out. But looking at cumulative measures of breadth in advanced decline data, is we really are able to assess the changing trends in advanced decline data, trend changes in breadth conditions. Here we have the New York Stock Exchange advanced decline line. Note how it has been unable so far to break above its December peak. Now, this is as the S&P has gone well above its December high, making new highs in January, new highs in February, of course, getting above 5,000 for the first time, but the advanced decline line has not done so. Now, the S&P, the large cap advanced decline line, has already done so. The mid cap AD line has even already broken out to a new swing high, but the New York Stock Exchange has not, and the small cap advanced decline definitely has not as well. So what does this tell you, where the S&P's AD line is trending higher, where the New York Stock Exchange is essentially sideways, and the small cap is trending lower? This tells you all you need to know about leadership, the fact that the market is going higher, and as much as we talk about broader participation, there are just a lot of stocks that are not really benefiting from the recent upswing, not making new highs, while the S&P and the NASDAQ are doing so. I think it's still a mega cap dominated market. There are other areas of the market that are doing quite well, as we mentioned, like energy and others starting to improve. But overall, the breadth data is really not speaking to broad strength yet. I would argue it's actually not confirmed in a lot of ways what we've seen from the broad indexes. Now, this is the McClellan oscillator, which takes that chart we just looked at and uses some exponential smoothing to turn it into an oscillator. Think of this as kind of like an RSI for the broad markets, but using breadth data as opposed to price momentum. And that's kind of how I would think of it. The McClellan oscillator, as of Tuesday's close, literally almost exactly at the zero line. I mean, about as dead neutral as we can come up with. Now, a lot of times you have these, weeks, if not months on end, where we're above the zero line, we're below the zero line, and that's the general way that I use this. If you look, it's been sloppy trying to get all these colors to line up with where I think these trends are going, because the McClellan oscillator has actually been quite noisy. When I think about the Hindenburg omen giving its initial signal last week before, that is based on new highs and new lows, right? Stocks going up and stocks going down all at the same time. And so the fact that the McClellan oscillator is just revolving around the zero line sort of validates what that is telling you, is that it's a mix of stuff. This definitely feels like a market in transition. It is not a clear bullish phase. It's not a clear bearish phase just yet. I would say from a breadth perspective, using this indicator, it's actually still more neutral than anything. Now, what is interesting is you're still seeing plenty of new highs. Now, this week, we've seen less and less stocks making new 52-week highs. So, for example, today, here on Wednesday the 21st, you had 27 members of the S&P. So that's about 5% of the S&P making a new 52-week high. A couple days ago, last Thursday and Friday, it's up here in like the 15 to 18% range. So way more stocks within the S&P making a new 52-week high, less and less as this week has gone on, and as a lot of leading names have pulled back. And I know like an NVIDIA not making a new 52-week high today, along with a lot of other names as well. So I would say the bear case from here would be the green bars drying up, and you're really not seeing a lot of red on here yet, but more and more red is what tends to happen during a corrective phase. Look what happened here in June, July, August. Look what happened here, where new highs were greater than new lows on most days, and all of a sudden that started to change here in August. Not at the peak, but a couple weeks after the peak. Look how you had lots of new 52-week highs in July, less 52-week highs and some expansion in new 52-week lows, and all of a sudden when you get to September, October, you get a bunch of new 52-week lows and very few new 52-week highs. That is a bullish to bearish rotation. That would be the bear case from here, is you'd start to see this happening on the charts for now. For now, they're still, I would argue, still okay. Stocks above moving averages, not particularly great, but not horrible yet. And again, I would say this is still sort of in the, not the end of the world, but telling you short term, we've certainly changed. If you look at what happened at the end of December, about 90% of the S&P members are above their 50-day moving average. And here's the S&P, of course, well above its own 50-day moving average, still through today. Very high above its own 50-day, which is down here around 48.30, and the S&P is here around 49.82. But if you look at all the 500 members of the S&P, about 90% of them were above their 50-day here. As of today's close, it's about 64%. So almost a third of the S&P have broken down through their 50-day moving average just so far in the first 6 weeks of 2024, right? Year to date, you're seeing about a third of the index. No, that's not true. That's not how the math works out. 25%. We'll call it a quarter of the S&P coming below their 50-day moving average. It's a pretty decent number. So a lot of stocks unable to hold that basic short-term measure of price trend. Now, long-term, things still aren't bad, right? So we're still above the 50% line. We're still well above 50% of stocks above their 200-day. So the long-term trend, I would say at this point, very much not in question. We can debate whether it eventually would break, but at this point, you're not seeing any sort of climactically bad, uh-oh, the world is ending. We'd have to have a lot more of a retracement. The S&P would have to come down quite a bit. A lot more names would have to break down than we've seen so far. But these are the charts that would help me track as that might be happening. So I think this chart is an important one, particularly to see if we hold above 50%, because if you look back in like mid-August, we were well up to 90%. We came down, and then eventually broke down through 50%. That was the sign that just things were starting to really get worse. We're not seeing enough of that yet. Overall, I would say the market conditions still kind of holding up. The last breadth chart that I'll show you is this one, the Bullish Percent Index on the S&P 500. And if you look, it keeps going down. So, it's interesting, as the market has held up okay, we just closed below 5,000 again today, but overall, it's been, we're not too far off of all-time highs for the S&P 500. But just like the percent of stocks above their 50-day have come down quite a bit, You're seeing the same phenomenon here year to date with this indicator, which is based on point and figure charts. So the S&P 500's bullish percent index was around 80% at the beginning of January. We're now down to almost 60%, around 63%. So what that means, again, 17% of the S&P, almost 1 in 5 S&P stocks, were a bullish signal here, had a bullish point and figure chart, and now have a bearish point and figure chart, meaning they've registered a sell signal just in the last 6 weeks. So the reason why the bullish percent index going above 70 and then coming back down could be such a powerful signal of a trend change, really a change in breadth, is because this represents, while this doesn't look like a big move, this represents a bunch of individual stocks that were in a buy signal and are now in a clear sell signal. Not a kind of sell signal, but a clear sell signal as defined by the rules of point and figure. So as this breaks down and continues to go lower, that gives me less and less optimism that the average stock is sort of working. This shows you that a lot of individual names are really starting to break down. So when I take a step back and think about the breadth conditions, I'm sort of looking at this a high level, looking at the advanced decline data, which is good as long as you're looking at the largest names. The smaller you get, the less bullish it starts to get. As I'm looking at the McClellan oscillator, I would say it's neutral at best. It's chopping around. The new highs, new lows for now is holding up. But I'm looking back kind of that July, August timeframe of last year and noticing how we may be beginning to have that transition we did there. And I need to see more 52-week lows to validate that things are really starting to change there. We're still okay in terms of stocks above their 50-day and 200-day moving averages, but I'm seeing a big deterioration in those numbers from where we were at the end of last year. So I would say January has had a very different breadth look with that indicator versus what we saw in November and December. Finally, the bullish percent indexes, which were quite bullish at the end of last year, have now become much, much less so. So I'd say the breadth conditions have gotten a lot less optimistic, a lot less bullish. The more that you look at these data points, the more you recognize a change year to date. And I would say the bull case for stocks involves these breadth conditions starting to improve. The bear case for stocks basically transitions into bearish readings here. And again, look back to July, August, September for an example of what a sort of garden variety pullback might look like. Look for similar patterns here in January, February, March of 2024, and that could be a sign of a deeper corrective period. Just before we wrap the show, it looks like NVIDIA for now is actually bouncing quite nicely, up 6.5% today. It's currently trading around 719. That would take us sort of, not even erasing yesterday's drop, but overall starting to bounce higher again. This is probably after the initial earnings report. You have the earnings call that comes later, and that's when a lot more details tend to come out. That's when you get some Q&A that happens, and that's when things can really become volatile. So the way that we're looking at after hours trading, and I would encourage you to keep an eye on this sort of screen after hours on an earnings day, is called our simple summary page. So switch the top of Stockcharts to simple summary, type the ticker there, you'll get to this page. Right here will show today's close, official trading day close, and then the after hours session time-stamped and showing you the change. You can glance down to see what that might do to the chart. Remember, after hour session is actually usually pretty lightly traded compared to other parts of the market. So it's all about tomorrow's open and what we do from there. That's it for banking on breadth, touching on some of the key conditions. Again, getting a little less optimistic. Still not horrible yet, but sort of a course charted out on what a more negative outlook might look like. With that in mind, let's wrap the show and go to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. Looking at 10-year Treasury yield, $TNX, I just wanted to point out that after bond markets rallied from the October low to the peak in December, and of course that's kind of this chart flipped upside down. Here we're looking at interest rates. So when the 10-year yield goes from 5% down to 3.8%, that means bond prices are essentially rallying. But from there, we've seen bonds selling off, and you're actually seeing rates come back higher. We just broke above the 38.2% retracement level here in the last week and a half. I think that opens the door to up around that 4.5% level. The poll question we asked recently was really thinking about that level and the likelihood of us getting back above there. And Final Bar Nation kind of split between whether or not that's possible. But I would think about what higher rates might mean for stocks that you hold, particularly this ratio here, which is value over growth, has been clearly favoring value for 12 months and counting. Do we get a bounce higher in value-oriented stocks? Maybe starting to see a little bit of that here this week. Chart number 2 is this one. Is Zscaler going to hold support? Zscaler we didn't get to in our market recap, but similar to Palo Alto Networks. This is one of those technology names gapping lower today. Ended up being sort of a doji candle type of thing. You had the open and close near each other. Earlier in the day, it was down, touching almost $200 a share, but rallied up to close right around 214. That's still down about 14%. And on a name like this, I mean, we had a bearish divergence as the price has gone higher. That's a clear warning sign during this phase of the trend. It suggests we're near the end of it. Now we've gapped below the 50-day. My question would be, do we hold that 38.2% retracement level? If we don't, look at the 200-day moving average here, right around the 50% retracement level, around 173. Finally, I think this sort of environment, what you can do is take a look at gappy names, things like JetBlue, things like Disney. We've highlighted some of these recent gaps. Some of the technology and FANG leadership names have had gaps recently, like Amazon and Netflix and others. The question is, do these gaps hold, right? For now, JetBlue gapped higher, traded a little bit higher, but now we're sort of testing the upper end of that gap. Disney, a very similar look here over the last 2 weeks. Gapped higher on earnings, moved a little bit, but now it's actually testing the upper end of that gap. If those gaps probably serve as key price support, but if they don't hold, that would be what a bear environment would look like, would be names like Disney and JetBlue, which gap higher, which seem to be pretty optimistic at the beginning, start to not look so attractive as price starts to retrace lower. So great opportunity to use the alerts functionality and focus on names that may or may not hold those price gaps. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. Please keep your great questions coming, and don't forget to answer that survey. There's a link in the description below. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.